Listen carefully, because this is where most retirees make a permanent mistake without even realizing it. You worked for decades, paid FICA taxes out of every single paycheck. Now you're about to log in, click Claim, and start receiving your Social Security benefits believing that monthly check is finally yours. But buried inside the tax code is a 1983 formula called Provisional Income that can quietly cause up to 85% of that benefit to become taxable the moment you begin withdrawing from the wrong accounts, and almost nobody explains how this chain reaction actually happens. The formula adds together half of your Social Security benefit, plus all of your other ordinary income, including withdrawals from a traditional 401k, traditional IRA distributions, pension income, CD interest, savings account interest, capital gains, and even tax-exempt municipal bond interest. And if that combined number crosses income thresholds that were set in 1983 and never adjusted for inflation, your benefits move into the 50% or 85% taxation tier automatically. Those thresholds, $25,000 and $34,000 for single filers, $32,000 and $44,000 for married couples, might have sounded like high income in the 1980s. But today, they can be triggered by a completely ordinary middle-class retirement where you simply pull $40,000 or $50,000 a year from a traditional 401k to pay living expenses. And once that happens, the IRS doesn't just tax your withdrawal, it taxes the Social Security on top of it, effectively stacking income in a way that feels invisible until April arrives. The irony is that two retirees with identical lifestyles and identical Social Security checks can end up with radically different tax bills depending on which account they draw from. If the money comes from a Roth IRA that was funded or converted before claiming, those withdrawals don't count toward provisional income at all, meaning their Social Security may remain largely or completely tax-free. But if it comes from a traditional 401k or IRA, every dollar increases the formula and pushes them closer to the 85% zone. The same hidden effect happens with high-yield CDs and savings accounts generating interest each year, and with taxable brokerage accounts that quietly issue 1099 div forms for dividends even if you reinvest them, all of which inflate the provisional income calculation whether you spent the money or not. What makes this especially dangerous is timing. The gap years between retirement and claiming Social Security are often the only window where you can strategically restructure, using phased Roth conversions to fill lower tax brackets, reducing future required minimum distributions that begin in your 70s, repositioning interest-producing cash, and cleaning up taxable brokerage allocations. Because once benefits start and RMDs kick in, your flexibility shrinks dramatically. None of this is about panic. It's about math and sequence. Claiming Social Security is not just a benefits decision, it's a tax coordination decision. And if you claim before understanding how your withdrawals interact with provisional income, you may unintentionally lock yourself into years of avoidable taxation. Before you file, before you withdraw, before you assume the check is fully yours, you need to calculate how each account affects that formula. Because the difference between a carefully sequenced retirement income plan and a reactive one can mean tens of thousands of dollars over a 20 or 25-year retirement. And once the IRS classification is triggered, it doesn't ask whether you meant to do it. It simply applies the rules.